Assalamu alaikum everyone. So we'll continue with the same chapter today, that is the 9th chapter, money market and capital market in India. In the previous lecture we have started with the organized sector of money market in India, and in that we have seen the first component of organized sector, that is Reserve Bank of India. In this lecture we'll see the other components of organized sector of money market. The second component is commercial banks. Commercial banks act as intermediaries in the country's financial system to bring the savers and investors together. They are profit-seeking financial institutions. Acceptance of deposits and granting loans and advances are the primary functions of commercial bank. Commercial banks play an important role in mobilizing the savings and allocating them to various sectors of the economy. It includes both scheduled commercial banks and non-scheduled commercial banks. Scheduled commercial banks are those included in the second schedule of the Reserve Bank of India Act 1934. In terms of ownership and function, commercial banks in India are often classified into four categories: public sector banks, which are owned by government; private sector banks by private individuals or institutions; regional rural banks; and foreign banks. The definition given by Banking Regulation Act of 1949 is one of the most popular definition of commercial bank. So according to the Act, banking means the accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, demand draft, order or otherwise. So we'll break the definition in different parts. The first one is banking means accepting of deposits of money. That means a commercial bank accepts deposits, accepts money from the general people in order to lend it or invest it. So it accepts deposit and grants loans and advances and makes investment. Now this loans and advances which is given by commercial bank to the general people is repayable on demand or otherwise. That means it is repayable at a stipulated time or on different terms and conditions set by the bank. And how this loans and advances can be repaid with the form, or this money can be withdrawn from the bank in the form of through a check or a demand draft or in any other form, say for example in exchange of bills of exchange or in the form of direct bank transfer. So there are different forms in which this money can be withdrawn or given back to the bank. So there are four different points in this definition. The first one is that it accepts deposit. Second is it grants loans and advances. Now this loans and advances are repayable on demand or otherwise in stipulated time. And the fourth point is that we can exchange this or we can transfer this money to the bank through various means, say for example check, demand draft, online transfer or otherwise. A bank is a financial intermediary, a dealer in loans and debts. So this is the definition of commercial bank. So we can there are n number of commercial banks in the country: IDBI, IFCI, we have HDFC, Axis Bank. All these banks are commercial banks. Now we'll study the functions of commercial bank. The first function is acceptance of deposit. Deposits constitute the main source of funds for commercial bank. Saving leads to the creation of deposits. Deposits are categorized as demand deposits and time deposits. What are demand deposits? Deposits that are withdrawable on demand are known as demand deposits. They are in the form of current account and savings account deposit. Current account is usually opened by businessmen, corporations, industrial houses. They are provided with the overdraft facility, that is, they can withdraw the money in excess of the balance in the account. Savings account are operated by a large number of people, particularly the salaried class, small traders, and so on, who wish to save a part of their income with the bank. So there are two types of deposits: demand deposits and time deposits. Demand deposit is further divided into current account and savings account. Current account is usually opened by businessmen and commercial institutions, whereas savings account is opened by general public or people belonging to salaried class or small traders. The second type of deposit is time deposits. Deposits that are repayable after a certain period of time are known as time deposit. Demand deposit does not have any stipulated time. You can invest or deposit the money for the period of time as required or demanded by the account holder, whereas time deposit is for a fixed period of time. They are in the form of recurring deposit and time deposits. Recurring deposits refers to a deposit wherein a customer deposits a fixed amount at regular intervals for a specific period of time. Fixed deposits refers to a lump sum amount deposited by customer for a specified period of time. Compared to all other deposits, fixed deposits carry a high rate of interest. Fixed deposit is done only once. That is, say for example, you invest a sum of rupees 5 lakh for 5 years or 10 years, then it will be termed as fixed deposit. Recurring deposit, on the other hand, is recurring in nature. Say for example, you have deposited 1 lakh in the bank today. After 1 year, you deposit 1 lakh again, and so on. So recurring deposit is recurring in nature. Fixed deposit is done once in lump sum amount for a longer period of time. The second function of commercial bank is providing loans and advances. Commercial banks mobilize savings, collect savings, and lend these funds to institutions and individuals for various purposes. Based on the tenure time, loans include call loans, which can be for say 7 to 15 days, short-term loans, say 1 to 2 years, medium-term loans can be from 2 to 5 years, and long-term loans which are for more than 5 years. Longer the duration of the loan, greater will be the rate of interest. Besides this, banks also provide cash credit, overdraft facility, as well as discounting of bill of exchange as its function. So cash credit, we can take the example of credit cards. Credit card is an example of cash credit. The bank provides short-term loan, certain amount to the credit card holder for a certain period of time. So it is a form of cash credit. So this is the second function or main function of commercial bank, that is to provide loans and advances to the people or institutions. Ancillary functions. Commercial banks also provide a range of ancillary services such as transfer of funds, collection of money, making periodical payments on behalf of the customer, for example, electricity bill or payment of taxes, merchant banking, foreign exchange, safe deposit lockers, buying and selling of securities, internet banking, mobile banking. So all these services comes under ancillary functions of commercial bank. The lockers provided by the bank, or the demat facility, or the buying and selling of shares provided by the bank comes under this category of functions. Credit creation. Credit creation is an important function of commercial bank. Just as central bank is responsible for controlling the credit, commercial bank is responsible for creating the credit in the economy. Commercial banks are creators of credit. Demand and time deposits constitute the primary deposits of bank. After meeting the reserve requirement out of the net demand and time liabilities, the balance amount is used for giving loans. The secondary deposits or derivative deposits are created out of the loans given by the banks. Say for example, when the bank provides loan to its customer, the loan amount is credited into the bank account of the customer. The bank that receives the loan amount as a deposit keeps aside a certain portion in the form of reserve. After meeting the reserve requirement, the bank lends the remaining amount. This procedure is followed by the entire banking system in the country, leading to creation of credit. In short, commercial banks create deposits out of the loans given, thereby leading to credition. Say for example, there's bank A. It gives loan to person A of 10 lakh rupees. Now person A will go to bank B and deposit this 10 lakh rupees as his deposit. Now this bank B will keep aside a certain amount which is required by the RBI as reserve. Say 2 lakh rupees the bank B will keep aside as reserve. Now rupees 8 lakh is the loan or the deposit which bank B will use for further credit creation. That is, it will give a loan of rupees say 8 lakh to another customer B. In this way, the loans or credit gets created in the economy. This is called as credit creation function of the bank. We have completed the functions of the commercial bank. Now we'll see the third constituent or the third component of the organized sector of money market. First is RBI, second commercial bank, and after commercial banks is cooperative banks. Cooperative banks came into existence with the enactment of the Cooperative Credit Societies Act of 1904. Cooperative banks supplement or support the efforts of commercial bank by meeting the credit needs of the local population. It fulfills the banking needs of small and medium income groups. The cooperative credit sector comprises of cooperative credit institutions such as primary cooperative credit societies, district central cooperative banks, and state cooperative banks. Another component of the organized sector of money market is development financial institutions. Development financial institutions are agencies that provide medium and long term financial assistance. They help in the development of industry, agriculture, and other key sectors. Industrial Finance Corporation of India (IFCI) was the first development financial institution to be established in 1948. So the primary function of these financial institutions is the development of industries, development of agriculture sector, and other important sector. The focus is on the development of medium and long-term financial institutions. Development financial institutions have diversified their operations with the help of liberalization and globalization. They have set up subsidiaries to offer a wide range of new products and services such as commercial banking, consumer finance, broking, venture capital finance, infrastructural financing, e-commerce, and so on. Development financial institutions are in the process of converting themselves into universal banks. RBI has issued guidelines for development financial institutions to become commercial banks. For example, ICICI has become a universal bank by reverse merger with its subsidiary ICICI Bank. Now, ICICI Bank had a branch or subsidiary which was a development financial institution called as Industrial Credit and Investment Corporation of India. It was a part of DFI, but now it has converted itself into a commercial bank and performs all the other functions of bank apart from focusing on industrial development. The last component of the organized sector of money market is Discount and Finance House of India. The Discount and Finance House of India DFHI was set up in 1988 as a money market institution based on the recommendation of Waghel Committee. It is jointly owned by the RBI, public sector bank and financial institutions to impart liquidity to the money market instruments. DFHI helps in clearing the transactions related to financial instruments such as shares, bonds, or trade bills, and so on. With this, we have completed the organized sector of money market in India. Now we'll see the unorganized sector of money market. Unorganized sector. The unorganized money market in India comprises of indigenous bankers, money lenders, and unregulated non-banking financial intermediaries. The activities of the unorganized money market are largely confined to the rural areas. That means you will mainly find or mostly find the unorganized sector to be part of the rural areas in India. The first component of unorganized sector is indigenous bankers. They are financial intermediaries that function similar to banks. They mostly deal in indigenous short-term credit instruments such as Hundi. The rate of interest differs from one market to another. Indigenous bankers are mostly confined to certain social strata. They are an important source of funds in unbanked areas and provide loans directly to agriculture, trade, and industry. Another component is money lenders. They mostly operate in the villages. Money lenders usually charge a high rate of interest. The loans provided by money lenders are for both productive and unproductive purpose. Agricultural laborers, small and marginal farmers, artisans, small traders usually borrow money from the money lenders. At present, the activities of money lenders have been restricted by RBI due to their exploitative tendencies. It often happens that the money lenders exploit the borrowers by charging high rate of interest, and as a result RBI has restricted the activities of money lenders. Earlier it was very common and villagers often used to go to money lenders and not go to banks when they were in need of money, because they trusted money lenders more than the banking institutions. And the last component of unorganized sector of money market is the unregulated non-bank financial intermediaries. They include chit funds, nidhi, loan companies, and so on. Under chit funds, members make regular contribution to the fund. Bids or draws are made on the basis of a criteria mutually agreed upon by the members. Accordingly, the collected fund is given to the chosen member. Chit funds mostly operate in Kerala and Tamil Nadu. Another name for chit funds could be BISI, which is very common in all parts of the country. Nidhi is also a type of mutual benefit fund, thriving on the contribution of its members. Loans are provided to members at reasonable rate of interest. Loan companies are finance companies. They provide loans to traders, small-scale industries, and self-employed persons. Being unregulated, they charge a high rate of interest on loans. So today we have completed the organized and unorganized sector of money market in India. We'll study the role of money market and other topics in the lectures to come. That's all for today. Thank you.